Big decisions, big wins. There's a lot to think about. So if you're thinking about retiring early, be sure to get informed. Look at your whole scenario. It requires doing a complete financial plan and getting all your ducks in a row.
Welcome to the Market Call Show, where we discuss what's happening in the markets and the impact on your investments. Tune in every Thursday on Apple Podcast, Google Play, Spotify, or wherever you listen to podcasts.
Welcome to the Market Call Show. This is Llanes. I am the founder of Wealthnet Investments. Today we have an interesting topic and I'm really excited about diving in, so let's get going. Welcome to the Market Call Show. This is Llanes. Today I want to talk about retiring early. A lot of people are starting to be in a position where they can retire early. Either they're being asked to retire early, or the company is giving them incentives to retire early, or they feel like they just want to be done working and they're ready to retire because maybe their portfolio has gone up enough, or maybe they've gotten company stock, things like that. I want to talk about what to think about in terms of pitfalls and what to think about in terms of ways to maximize that decision, because that decision is a big decision. And in my book, Financial Freedom Blueprint, I talk about big decisions, big wins. There's a whole section on this. And I want to talk a little bit about that today because it is so important to many people. Just the other day, one of my clients had referred a couple of different people who were in the healthcare industry. And one person actually was given an option to get a 6-month pay and some other types of pension accelerations and things like that. And this is really common. People are getting in a position where the company are saying, you know what, maybe we want you to retire, or we're going to give you some incentives to retire. It's not an easy calculation. It's not something where you could just go, oh, on the back of an envelope, I'm just going to calculate whether or not I should do this. Or you don't want to do it by gut feel. You want to do it based on numbers, and you want to do it based on all these different factors related to your life, your spouse, your children, things like that. So I want to talk about a few different scenarios that we've really been seeing a lot. The first has to do with whether or not they should just relocate, because relocation seems to be something that's happening a lot. It's possible that many people can accelerate their retirement by just relocating. So when you're moving to a new state, let's say you're moving from a high tax state to a lower tax state, that could be a really big, helpful decision for you. It could actually allow you to retire now. One of the biggest decisions you have is, what is that future impact going to be for me if I decided to move? Let's say you're moving to Florida or to South Carolina, or maybe you're moving to Memphis. Who knows? There's all these different places. People are moving to Arizona, Austin, Texas is a big one. So, you could lower your taxes and cost of living if you're moving from up east, or if you're moving from the West Coast. A lot of people are finding that to be a big, big help. So I would say keep that into your consideration if you're thinking about maybe retiring soon. You might actually know an area that has a better tax scenario for you. And it's important to understand, and I know most people are cognizant of this, each individual, it's not just the state, it's each individual area has different taxes as well. Sales tax, real estate taxes, they vary even within the state. So having a plan for researching areas to live could be a good starting point if you haven't already done that. Another big scenario that we see a lot is people have company stock and they're looking at that in terms of how can that help me retire. One of the things that's happened is the market has been really good, in particular for people in the tech sector. Clients that we've noticed on the West Coast have had some big successes with stocks, and many of these stocks are highly priced relative to their earnings and their assets. And a lot of people are over-concentrated in these company stocks, and they don't want to sell it because they feel like it's almost like a FOMO, fear of missing out. If I don't sell some of this, then I'm going to make a lot more money. And it has been the case in the last 5 years that selling has not been the right thing to do. In many cases, though, we're seeing that diversifying is making sense now, because those values are higher. So don't over-concentrate in your company's stock. Try to diversify it. You're probably never going to sell the stock at the highest value. What really, really matters is that you get a reasonable price for it and that you do what's necessary to achieve your goals. So here are some questions that I would ask to determine whether or not you should pare back some of that stock. The first is the stock greater than 20% of my net worth? If it's greater than 20% of your net worth and you think that you almost might be ready to retire, or maybe within the next 5 years you will, then almost likely, almost for sure, you should probably be selling some of it in today's market. Second question I'd ask is the stock overvalued based on earnings growth and the net assets of the firm? So if you have a really nosebleed price, yeah, maybe it's time to pare some of that off. Another question I would ask is how much of any stock I sell would be taxable gains? So a big part of this decision has to do with taxes. And this can get pretty complicated because you have alternative minimum tax that can come into play, and there are a lot of different moving parts. And really the only way to solve your tax scenario, to figure out which lots to sell, which specific shares to sell, the only way you're going to be able to solve that is by running the complete analysis through a tax software program that your CPA can do for you. So tax planning with a CPA and a financial planner is really crucial because you got to know which lots to sell and you got to know when to sell them. Sometimes it makes sense to sell them after the first of the year. You want to look at the price, but you also want to look at the tax impact. And there's different taxable gains on different lots. So keeping that in mind. Also, different types of company stock programs have different taxation as well. You have restricted stock units or RSUs. You also have non-qualified stock, and they're all taxed differently. So keep that in mind for sure. Another question to ask is, what's my current tax bracket? So if you're going to have a lower tax hit this year, then maybe you can pare back more stock this year versus next year. A lot of shares can be sold when you're in an uptrend. I think that's the best way to do it. You're in an uptrend. Don't wait till the stock is already in a downtrend. Recently, we had a client that we've been trying to get to pare back, and had they just followed the basic discipline of rebalancing, that they wouldn't have had such a large drop in the stock, even in this bull market. So you want to sell as it's going up if you can. And obviously you don't want to sell it all, most likely, especially if the company's doing well, it's just overpriced. But getting that stock diversified can make a lot of sense.
If you worry about your investments, need to make complex financial decisions, or pay unnecessary taxes, a lack of proper financial planning and investing may already be costing you a great deal. When you are ready to turn your peace of wealth into peace of mind, go to wealthnetinvest.com and click on the Schedule a Call button to talk to us and get a free consultation today.
All right, so how to manage a concentrated stock position? It's really a question of asking yourself, am I financially secure right now, even if the stock goes to zero? For most people, if you have a lot of money, a lot of your net worth in a company stock, if it went to zero, you're probably not financially secure. So that has something to do with your decision. So you want to get to that financial security so your assets are working for you and can provide a income stream for you for the rest of your life at a certain level. So if you're financially secure without the stock, even if it went to zero, then you can take more risk on with that stock and really shoot for the moon. But if it really means a lot to you and your financial security is at stake in that position, it makes even more sense to pare that back. It's also important to get an outside perspective about it because we can get really biased when we look at our stocks, especially when you've been working for a company, the company's done very well for you. It's really easy for us to feel, wow, this is the best thing since sliced bread. I should stay with this. But it's really important to get an outside perspective with people who understand how to value companies, what other companies are worth in your space, how well the company is truly doing versus competitors, and have more of a balanced approach rather than just going with your own gut, because that could also lead you astray. Don't let tax worries kill you, okay? Don't let them kill your net worth. The biggest blunder I've seen with people that make a lot of money in company stock is that they can't let go of the stock because they're so worried about things and they let the tax just kill them. You must avoid selling your stock when it makes sense to, just because you want to avoid taxes, okay? You have to be careful with that. Don't let taxes run everything on your decision making. When things go wrong for a company, prices usually fall, and they fall a lot faster than they rose. So in the cases that you find yourself where less than half of your nest egg is gone very quickly. A lot of times that happens because people wait on taxes. So there's a balance between the valuation and the tax bill. So don't get hung up on taxes and lose sight of the objective truth about your company's future. So objectivity is key with that. Now, I've spent a lot of time on the taxes, and I want to move on to some of the other things to think about retiring early. I spent a lot on the company stock part of it because that seems to be something that's happening a lot. Another thing that's happening a lot for people is they're getting pension buyouts, or they're getting the opportunity to maybe get an acceleration of their pension. So it's really up to you to maximize your 401k retirement plan and your pension and all of that. It's not always easy. Now, if you're one of the lucky ones and you have a pension, it's really important to understand that you may be able to be better off if you roll your pension into an IRA and take control of your future and find out what is best for you, because it's important to compare your return that you expect from that income stream that you would get. So if you kept that pension, or if you waited to a certain age, what is that income stream going to be? And compare that to if I took a lump sum and if I invested it. And you want to make conservative assumptions about your investment returns. And what I've been noticing is a lot of times these companies and big companies tend to do this. They say, here's your pension payout, and then here's your lump sum amount if you want that. And when you do the analysis, we do what's called a net present value analysis to figure out what makes more sense. A lot of times the implicit rate of return, or the embedded rate of return that's inside of the pension, is so low that it doesn't make sense to hold that pension. You'd be better off to roll that into an IRA sometimes and not pay any taxes on that transaction, and to invest that in a balanced way where you're blending that portfolio and then taking the income stream from that portfolio, rather than go in the other direction. So that's something to always consider. It does not always work out that way. Some companies have very, very attractive pensions, and you just want to keep that pension and you want to take that income stream. Usually, in particular, when those income streams are going up over time, so like built into the pension is a rising income stream, then a lot of times those can make sense to keep. But most pensions that we see, I haven't been seeing a whole lot of pensions with rising income streams. Another thing to think about when you're thinking about retiring early is, what is the way that I can take the most advantage of my investment strategy? If you have money in real estate, rental income properties, and you have also some money that is outside of retirement accounts, you may be at a big advantage in that you could use that money and invest it in a way where you have a tax-managed portfolio, where the stocks and bonds are managed in a way where the interest is tax-free, and the stock portfolios are managed so that capital gains are minimized. And in that case, you will have more liquidity, more flexibility to take advantage of opportunities and to not pay as much taxes. So if you're in a position where most of your money is in retirement accounts, or what's called qualified retirement accounts, a lot of times what happens is you get nailed on taxes, because every single dollar you pull out of your retirement plan is considered taxable income. It goes in that line as taxable income, almost like a salary. So it's very difficult to avoid that. If you have all of your net worth in qualified plans or retirement plans like 401ks, 403bs, pension plans, you might get stuck with some pretty big tax bills. So it's good to have what's called tax diversification, where you're splitting up your assets in a way where you have money outside of it. So there's advantages to having tax managed portfolios, to have other types of assets, rental income as well. That way you can have more flexibility in your tax planning. So it takes sound thinking. And sound thinking leads to sound actions. So making those choices is super important. So big decisions, big wins. There's a lot to think about. So if you're thinking about retiring early, be sure to get informed, look at your whole scenario. It requires doing a complete financial plan and getting all your ducks in a row. Well, that's all I have for now. I hope this is helpful for you. If you have any questions, feel free to reach out to me and to us. And if you like this information, like and subscribe. My book, Financial Freedom Blueprint, just got published, just launched. And I want you to go to pathtorealwealth.com and check it out. you can go and pick up a copy of the book, learn more about it. And on that website, pathtorealwealth.com, you'll also see information, some other podcasts that I've been interviewed on, and some other interviews that I've done, like in New York. And you might find some good information on that site. All right, that's all for now. Louis Llanes signing off, and we'll talk to you soon.
For the latest episode of the Market Call Show, make sure to like, subscribe, and follow us on Instagram, Facebook, and YouTube. If you enjoyed the content of this episode, please leave us a review and comments. The information in this podcast is informational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. Wealthnet Investments is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Wealthnet Investments and its representatives are properly licensed or exempt from licensure.